Hello, this is Rachel from Kalkinemedia and you're watching Kalkinemedia's educational series. Please subscribe to our channel and press the bell icon for notifications for our latest videos. The greenback is the lifeline for global markets. Any changes in its value are crucial for investors around the globe due to its diverse implications. A strong dollar is generally a sign of relief for investors and experts as it fuels high economic activity in the US and globally. The International Monetary Fund estimates that over 61% of the global bank reserves are denominated in the US dollar. This is a key factor reflecting the strength and capacity of the US economy to influence major global markets. Despite skeptics stating that the greenback has lost its control to the euro, the global impact of the currency cannot be ignored. A greenback rally can both be a good sign and an alarming signal depending on where the rally stems from and who it affects. Generally, currency appreciation can mean a dip in net exports. As many international currencies are pegged to the US dollar, a rise in the dollar impacts these foreign currencies as well and has further consequences on their economies too. In the mid-1940s to the early 1970s, the Bretton Woods Agreement and system created a collective international currency exchange regime. It marked the official takeover of the US dollar as the world's reserve currency. Countries started holding on to the USD instead of gold. Since then, major economies around the globe look at the USD to tap where the commodity and equity markets are heading. It's interesting to note that the greenback has earned its reputation despite the United States being in copious amounts of debt, with an economy seeing high levels of deficit spending. Being a debtor nation has not impacted the US financial market strength. So what is a rally? Well, currencies are volatile in nature, which makes them susceptible to daily changes influenced by underlying economic and financial market trends. Exchange rate appreciation and depreciation is a phenomenon observed quite often. A rise in the value of domestic currency compared to a foreign currency is known as currency appreciation, and a decline in its value is called depreciation. Both these are commonly used terms. However, a sustained rise in the value of a currency leads to what is known as a rally. Generally, a small uptick in a currency is ignored and not taken as an alarming signal. However, a prolonged rise in the value of a currency has certain implications, as well as underlying causal factors. A currency rally is especially significant for investors as it impacts not only the commodity market, but also the money and equity markets. Now let's take a closer look at the causal factors behind a rally in the greenback. The changes in the US economy have far-reaching impacts on the outside world. The USD is one of the channels through which the changes observed in the US economy seeps to the other parts of the world. Here are some of the factors that affect the US economy and, as a result, other economies too. A high stimulus boost. Fiscal stimulus is one of the key areas influencing the value of money. Add to that a favourable monetary policy and an increased supply of money is observed in the economy. An increased supply of money allows greater consumption and greater investment. Record low interest rates make lending cheaper, allowing individuals to invest more. Therefore, higher growth can be expected due to these favourable policies. High-growth economies are investor favourites and see an inflow of increased foreign investments. To facilitate an investment in the US, investors demand the USD, which in turn puts pressure on the supply of USD. Consequently, the value of the USD increases. Recovery from recessionary pressures. Economies coming out of a recessionary pressure are likely to see higher growth. Recession is typically marked with low inflation and high unemployment levels. When an economy recovers from a recession, it experiences high economic growth and increasing price levels. The recovery phase sees increased investment and demand for goods and services as people regain employment and joblessness declines. Companies usually experience higher turnover, leading to their improved stock market performance. The US Treasury Yields are an international benchmark for bond yields. Treasury yield can be understood as the percentage returns obtained by an investor after investing in the government's debt obligations. A rise in Treasury yields is often accompanied by increased yields on government bonds and other types of bonds as well. Therefore, Treasury yields are often used to tap the well-being of an economy. Rising yields can attract foreign investors and can bring in increased investments. This has an impact on the exchange rate as the demand for the dollar spikes. If Treasury yields maintain too high for too long, then it can also lead to inflation. Also, increased positive sentiment can have an impact. When favorable economic policies are implemented, traders generally develop a positive sentiment. This occurs where economic indicators like GDP, wages, and employment level turn out to be favorable. Using these factors, investors try to analyze where the market is headed. A positive sentiment is generally accompanied by increased investment and therefore increased demand for the dollar. There may be times when this positive sentiment persists in the economy for long. So what is the impact of a greenback rally? Well, while a USD rally may seem like a period of high growth and increased economic activity, investors must also be cautious of a currency rally. Commodities have an inverse relationship with USD movements. This means that a USD rally generally tends to pull commodity prices down. A perfect inverse correlation may not be visible. However, broadly, both these factors have been observed to move in the opposite directions. This happens because the USD is the currency in which most of the international trade happens. Therefore, less amount of money is needed to buy a single unit of a commodity when the USD appreciates. A strengthening dollar can also be good news for stock market investors, as it allows them to churn in higher profits from their overseas counterparts. However, often a greenback rally receives a mixed response from experts, as it has the potential to wreak havoc in the financial markets. Emerging market currencies can plummet, affecting the dollar-denominated debt of the corresponding countries. Additionally, corporate earnings may also suffer, leading to stock market downturns. Therefore, investors need to be cautious of their investments during a period of a greenback rally. If you like this information, please like, share, and comment on the video and subscribe to our YouTube channel. Press the bell icon for notifications for our latest videos. For regular updates and more information, log on to our website, kalkinemedia.com. I'm Rachel Jones, signing off for Kalkinemedia.